everyone. Welcome to yet another week analysis. So, for this week, we're going to be talking about two things, right? What pair to trade and something called, follow the money, transfer of, assets, transfer of wealth. Now, my name is Kelvin Area, and I've been trading for about 4 years now consistently. I journal my trades, I plan my trades before the market opens. So I come in with a premeditated plan, and I do not act over off of emotions or off of FOMO and whatnot. So let's get into it. Right? For this week, we're going to be talking about. Let me start with transfer of assets. Now, there's something you need to understand about the markets, right? When the markets are trending or in a range, to be very honest, from experience, I would say you should not get involved. You want to get involved in the markets that are trending. And I've said this before, a trending market is a market that is moving in the overall direction of the trend. I say this again. A trending market is a market moving in the overall direction of the trend. Now, the question you might ask is this: how then do we know, Kevin? How do we know the overall, structure of the market, the overall, direction of the market? Simple. You go into the monthly time frame, not the weekly time frame, not the daily time frame, not the 4 hour time frame. Some people use the 15 minutes to get their trend, but okay, to each his own, innit? But you go into the monthly time frame. The monthly time frame helps us to identify the overall what direction of the markets. The overall what direction of the market. Now, the monthly time frame on the DXY, the dollar index, is bullish. Structurally, it is bullish. But right now we are in a range, meaning we're underneath a place that we should not be. The weekly time frame is bearish, the daily time frame is also what bearish. So we should not be involved in a market like this. Now, whenever the dollar is in a range, every other thing goes in a range. The United States dollar is in control of basically the whole world. It is the most powerful currency in the world. It is priced with the dollar. It is priced with it is priced with gold, oil. Everything is measured by the dollar. Now, why would you want to go? If look at Japan for example, right? For Japan to be able to get out of the porous currency that they have, they need the American dollar to go weak for them to it's what I'm saying, to be strong. So you can see everyone needs help from America. Everyone needs the dollar to be bearish. Everyone needs the dollar to be bullish so that they can survive. Now, knowing this, the DXY is my GPS, my map to reading, to telling me if I should be involved in currency pairs or not. Now, you need to understand that investors do something called transfer of assets, right? As an investor or as a trader like you and I, we are retail traders, right? So it is very important to understand when to move your capital from this asset to that asset, from dollar to hard asset. It's what I'm saying to you. So I trade the dollar and I trade gold. Reason being, whenever the dollar is in a range, the gold is trending. You see what I'm saying to you? Gold is trending. So why would you want to keep on being in the range when you can equally just go to gold and trade it the way you also trade the forex pairs? It's the same analogy, the same technical analysis, the same not the same, but the fundamentals are quite similar because the dollar is bearish, hard assets are being bought by investors. Simple as ABC, isn't it? So knowing this and keeping that in mind, we then understand, all right, the dollar is in a range. The weekly time frame is giving us a double top. I've said it before. Pay attention to the double tops. Pay attention to the higher time frames chart patterns. Pay attention to those. It's something to you. These are the things that tell us where the market is headed. It is in a range. The daily time frame is bearish. The weekly time frame is bearish. The monthly time frame is bullish, right? But we cannot trade that. It's something to you. From experience, it is best to trade the asset that is moving in the direction of the monthly time frame. That's how you know a trending market. Is it moving? Are you able to trade it in the direction of the monthly time frame? If you're not able to trade it in the direction of the monthly time frame, then why are you involved? Why are you involved? Right. So right now, until the dollar shifts its direction, I am not involved in dollar. So I've taken my my focus into into gold. I'm moving my capital into gold. Right. So the first thing is first, the monthly time frame. Similar as ABCs, right? Let's go into the monthly time frame. I want to analyze this market without all of these lines. So I'll just go and look for gold somewhere else, right? So let me look for gold somewhere else, right? So it's best to analyze it without naked chart. So I'll show you that I could do this with my eyes closed, right? You should be able to do so, right? Too. So now this is gold on the naked chart. This is the monthly time frame. It was at higher highs. It was the highest it's ever been, and now it's down here. Now, last week I talked about three things, right? But one of the most important thing I said was candlestick patterns. There are chart patterns. Chart patterns are double tops and double bottoms, right? Head and shoulders, inverse head and shoulders. These are chart patterns. But now there are some. There are also some. There's something called uh, candlestick patterns, meaning morning stars, just like so. Three candle formation, like so. Pin bars. Hanging man, dojis, gravestone dojis. You need to read. You need to read. Trust me, reading is very important when it comes to trading. Whenever you spend time in the charts, right, on the chart rather, and then you then go to pick up a book, the same book you've read in the past, you pick it up again, I bet you will see something different. Trust me, every time I've experienced this, every time you always see something different. It's like you watching the same movies you've watched or the same cartoons you've watched when you were a little child, right? When you were a baby, and then you've grown and you've seen some things in the world, and you're like, oh, so that's what that was. You get what I'm saying to you, and I know some of us experience these things in our lives as well. So I'm just gonna bring your our lives into training, so you understand the same thing that happens, right? So the first things first is this: gold has been bullish since gold can be bullish. You see what I'm saying to you? Gold has been bullish since gold can be bullish, right? So the first things first is this: we had a pullback. We had a pullback, and then it's very important to understand that when you start seeing pullbacks like this, it does not mean that the structure is about to shift or anything. It simply means that the market has been trending, it needs a rest, it needs to recombobulate before it starts to push. Now, guess what? Whenever that happens, assets are being shifted. Investors are moving money from here into there. So when this pullback started happening on gold, right? I can bet if you go to the dollar, you will notice a push up into you notice the dollar was trending at that time. It was moving in the direction of the monthly time frame. I say this again. The trending market is a market that is moving in the direction of the monthly time frame. Why the monthly time frame? The monthly time frame, as retail traders, helps us to see the overall direction of the market. Some people trade the daily direction of the market. Some people trade where the market is going to go in the next 4 hours. I trade where the markets are going to be in the next month, in the next quarter. So for these next 3 months, if you notice, right, it took the market to 1 month, 2 months, 3 months, 4 months. It's something to you. It took 4 months for the market to pull back, basically a whole quarter, and 1 month. And then what do you think is going to happen? It should take us about a quarter as well, 3 months, for us to then rally up to the upside. So we then know, all right, for this next quarter, this is how investors think. For this next quarter, they think long term. All of us we're looking to day trade. What are you doing? They think long term. For these next 3 months, I should be trading gold. Why? Because assets are being moved, redeployed. For these next 4 months, I should be trading gold. Why? Because assets are being redeployed. The dollar is going to be weak, so gold is about to trend. Now, how do I know as a trader that gold is about to trend? We are in the golden zone. This is take one. I said this is what take one. This is reason one. Reason one is we're in the golden zone of the Fibonacci time, the Fibonacci two. Reason two is this: chart patterns. So candlestick patterns. What's reason two? We then pulled back into Fibonacci, right? All right, then what should we expect next? I said, whenever you are having a U-turn, you're driving and you're about to take a U-turn, right? Do you take a U-turn with high speed, or you take a U-turn, you first stop, you reduce your speed, and then you turn? Is that not how all drivers do it? The exact same analogy is in trading. You're about to take a U-turn in the market. What do? You get to the point you get to the U-turn, you get to the point where you have to take your turn, and then what do? You slow down, you stop, you put on your pointers, and then you move. The same thing happens here. We drove on high speed, we got here. This is high speed. This indicates high speed, right? Huge candles like this, the momentum indicates high speed. What did we do? We got there and we stopped. Now, how do you know stopping candles? Stopping candles like dojis, pin bars, hammerheads, inverse hammerheads, candles with a small body and a very long wick are stopping candles. This is the stopping candle. This right here is a stopping candle. This is a doji. If you see a candle with a small body and a long wick, that is the stopping candle. These are analogies that you need to adopt into your trading. Trust me, it will help you avoid unnecessary losses. It will also help you get into the market at the right time. Now, this month we have 23 days to the end of the month, right? And then we should expect this candle to be the push to the upside. It's something we should expect this candle to be the push to the upside, and this candle might end up closing above this candle, and that would be very, very great, right? And then now that we know, all right, the market or the monthly time frame is about to continue the trend it was embarking on, we go on to the weekly time frame. Now, what do we use the weekly time frame for? I use the weekly time frame to mark my areas of interest, where I'm going to buy or sell from. Now, if you notice on the weekly time frame, we were never bearish. Oh yeah, market structure, simple higher highs and higher lows. On the monthly time frame, we were never bearish. Higher high, higher low, higher high, higher low, higher high, higher low, higher high. This is market structure. This is what a bullish market looks like. And then break of structure, retest of the left shoulder. These are things you would not see on these are things you will not see on fake gurus, mentorship. Anyway, let's move forward. Let's leave those boys alone. Then a lower low, right? And then the lower high into this head and shoulder that it has created. You see how easy this looks, isn't it? And then the lower low and then a lower high. You see how we've transferred from we've conformed from this into this, and it looks very easy to identify, isn't it? So the exact same thing right here. Higher high, higher low, right? And then we had a push to the upside, and then created lower lows and lower highs. But these lower lows and lower highs are not shit for structural lower lows and lower highs. These lower lows and lower highs you see around here, these are pullback, lower lows and lower highs. Until we break this structure right here, we body close. Then that is when we say, oh, we're bearish. So the monthly time frame was never bearish, even though we had a pullback. The weekly time frame was also never bearish, even though we had a pullback. So we then go into the daily time frame to then trade the direction of the overall trend. If I go to the daily time frame and I cannot execute in the direction of the monthly time frame, I do not trade the pair. It is not trending in the direction I desire. It's not trending in the direction that it should be trade trending at. So on the weekly time frame, or rather on the daily time frame, we saw that if we broke structure. Obviously, we broke structure, right? We became very bearish. Until then, we came into this area of interest. On the monthly time frame, we got our turnaround candles, and then we're expecting momentum now, right? And if you also look at the counter trend line, we've also broken the counter trend line as well. Even though I do not really use counter trenders like so, but I would expect to use the counter trend because this is another trick I adopt, right? I adopted into my trading. If the first and for example, right, the structure to break is right here. Because I'm a structural trader, I trade market structure, price action. It's very important. Lower lows and lower highs, lower lows and lower highs, lower lows and lower highs, right? I'm just trying to share this with you, right? If for example, right, then this is the structure, this is the area of interest, right? And we're expecting to break this structure right here. I cannot wait. I can't wait, but it is unwise to wait for this break of structure right here and then execute on the left shoulder and whatnot. But if, for example, I can then execute this trade by the break of this kind of trend line into the direction of the monthly time frame, you see what I'm saying to you, right? So and let's see, and then we broke the candle trend line, but we haven't broken structure yet. But the most important thing is this: I am trading in the direction of the monthly time frame. So there is something that tells me, okay, you know what? I think we should be able to, it's not premature, but we should be able to execute and take this risk. Take this risk. Emphasis on what taking the risk. Take this risk in executing in the direction of the monthly time frame. Even though it goes against me and I take a loss or whatnot, the most important thing is this: I traded in the direction of the monthly time frame. That's the first step to success. For those who are looking to be effective with their strategy, that's the first step to success, right? Trading in the overall direction. Your overall direction could be the weekly time frame. As long as it is an overall direction and you're not buying today, selling tomorrow. Imagine me coming into the market next week and then I tell you sell gold. You will think I'm dumb. You will think me stupid, isn't it? Because last week I came and I said buy gold. I'm expecting to trade gold for like the next 3 months. This is my plan for gold. I'm expecting to trade gold for like the next 3 months or 2 months. And I then come next week and say, you know what? I think we should sell gold. That's stupidity at this point. I don't know where I'm headed. I'm moving like a headless chicken. That's just how I see it. And also for gold, you can see how we've been able to identify the direction, identify why the market is turning around. Now, easy as ABCs. This is how I mark my areas of interest, where to buy and sell from. This is how I do it. I look left, right? I look into the past and I plot out my previous weekly time frame, areas of interest like so, right? So the next area for me is right here. I plot them on the higher time frame. It's best to plot on the higher time frames. And then this area right here is a pullback, is an area of interest from the monthly time frame. So it can be used to, it can be used as a reference point to then shoot the trend of the market. So that's why it is going to be this huge. It's black. It's a major area of interest, right? So, and then now I see, all right, for me to be able to execute this market, I have to wait for this one to be the next area. So I go to the daily time frame to see if I can get more immediate areas of interest. Now, this is how I then plot the immediate areas of interest on the daily time frame, right? Now, the monthly time frame, or rather the daily time frame is not as strong as the weekly time frame. It is fact. So, for me to be able to find something that is going to be respected by the weekly time frame, I need to make sure it is a chart pattern. So on the daily time frame, I make sure, all right, this is a double bottom right here, right? You can see this right here is a double bottom, like so. And I need to make sure it touches more than one. So if it's touching there, it should also touch, like so. So double bottom, and then it touches around here. So this is perfect. And then the neckline, like so. I use the neckline. I use chart pattern. I use everything in the neckline, everything in the chart pattern, right? And then you can see one, two, three. You can see another double bottom right on top, neckline right below. You see right below. You can see how much it gathers. You see what I'm saying? It gathers, and you can see another double bottom right so, right here like so, right, and then a neckline like so. Boom, neckline here, double bottom here, and then a break and a retest here. And then if you remember, this area of interest was gotten from the weekly time frame, right? But if you look in, you will see that this is also a double top. You see that this is what also a double top, and this makes it all the more even more juicy to sell or buy from, like so, double top. And then I move up a little further. I need to be able to execute. The moment I get my entries, and I can see that this is a head and shoulder, right? So left shoulder, right shoulder. I use the neckline. I would also use the shoulder point, but it is too close to the area of interest to the final take profit. So there's no point. So for gold, this is how I execute. And there's also a neckline right here. This is the double bottom, right? There's also a neckline right here. It may look like it's too much, but trust me, a premeditated area of interest is way better than you then trying to pinpoint when to buy from or sell from. This works for me. You have to look for whatever works for you. You can see my thought process into how I plot my areas of interest. This is how I do it. So you have to look for what works for you. So you can see, I have all of these space to execute. I have all of these areas of interest to trade off of. Fine, I make money. And then from where the from the beginning of where I'm looking to buy and sell from into this overall take profit is about 23%, 1,000 pips into the future. 1,000 pips into the future, simple as ABC, right? So, let's go to the 4 hour time frame. You can see the market has already started moving. Things are happening already. Things are happening already. So I missed the trade for this week. I was expecting to come a little lower because of the weekly time frame neckline, but we move on, we learn and we move on, right? So a push up, a pull back into the area of interest, and a push. So now for next week, I'm expecting this to happen, and then I'll execute into the future, and like so. This is what I'm expecting to happen for next week. Nothing more, nothing less. Just like so, right? So I hope and I pray that you follow your trading plan, because I've planned my trades already. I'm just waiting for you to come into the direction, come into the area of interest that I need it to. I need it to do what I need it to do. I'm not going to confirm and then say, "Oh, it's a new week," or the markets are looking, a lot different, and then let me compromise. No, that's a recipe for disaster. So follow your trading plans. Have a great week. Goodbye.